Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Construction Partners, Inc. quarterly report. Construction Partners, Inc. offers a wide range of services and products for various infrastructure projects. The company's primary focus is on constructing and maintaining roadways across 8 states, including Alabama, Florida, Georgia, North Carolina, Oklahoma, South Carolina, Tennessee, and Texas. The company provides various products and services to public and private infrastructure projects, such as highways, roads, bridges, airports, and commercial and residential developments. In addition to construction and maintenance services, Construction Partners also engages in manufacturing and distributing hot mix asphalt, HMA, for internal use and sales to third parties. Furthermore, the company is involved in site development activities, including the installation of utility and drainage systems. It also mines aggregates such as sand, gravel, and construction stones that are used as raw materials in HMA production. Additionally, Construction Partners distributes liquid asphalt cement for internal use and sales to third parties in connection with HMA production. The company's services can be summarized into several key areas: roadway construction and maintenance, manufacturing and distribution of hot mix asphalt, HMA, site development, aggregate mining, and the distribution of liquid asphalt cement. Construction Partners, Inc., NASDAQ, ROAD, has experienced a significant stock price increase of over 55.94% in the past year due to several positive news events. The company's robust Cone fiscal year 2026 results were a major contributor to this surge, with revenue growth of 44.1%, exceeding analyst expectations. Additionally, Construction Partners reported impressive earnings per share, EPS, of $0.47, significantly beating consensus estimates. The company's strategic acquisitions, such as the completion of GMJ paving in the Houston area, have also enhanced its operational capacity in key Sunbelt markets. Furthermore, several analysts raised their price targets for Construction Partners following the strong earnings report, with D.A. Davidson increasing its target to $130 from $120, and Baird raising its target to $142 from $124. The company's long-term growth strategy, known as Road 2030, aims to double revenue to over $6 billion and push EBITDA margin towards 17% by 2030. This ambitious plan has signaled sustained growth prospects to investors, contributing to the stock price increase. Overall, Construction Partners' strong financial performance, strategic acquisitions, and optimistic long-term outlook have driven its significant stock price rise in the past year. Construction Partners, Inc. maintains a market capitalization of $7 billion, broadly in line with the industry peer group. Construction Partners, Inc. trades at a higher price-to-earnings ratio of 57 times and a lower price-to-book ratio of 7.39 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. The leverage on the balance sheet appears elevated, with liabilities of 72% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline are multifaceted. On the growth side, acquisitions have been a significant contributor, with $228.2 million in revenue generated from such transactions. Strong demand in existing markets has also played a crucial role, with a 3.5% increase attributed to public and private work. Additionally, contract work and sales of HMA and aggregates to third parties have added $19.7 million to the revenue pool. Furthermore, the shift towards public infrastructure construction projects has been notable, with these projects accounting for 65.3% of consolidated revenues in 2025 compared to 57.7% in 2024. Conversely, private infrastructure construction projects have seen a decline, making up only 34.7% of consolidated revenues in 2025 compared to 42.3% in 2024. On the other hand, factors contributing to revenue decline are largely external and include unfavorable economic conditions, restrictive financing markets, inflation on costs of labor, raw materials, and other essential items critical to the business. Competition for projects in local markets is also a concern. These challenges underscore the importance of adapting to changing market dynamics and mitigating risks to maintain revenue growth. The financial performance of a company underwent significant changes between 2024 and 2025. Net income saw a substantial increase from -$3,051 to $17,205, resulting in an overall gain of plus $20,256. This improvement was attributed to various factors, including the expansion of operations through acquisitions, increased revenue potential, and a decrease in the effective tax rate. Profit margins also experienced notable growth during this period. The gross profit margin rose from 13.7% to 15%, while operating income margin jumped from 2.4% to 6.2%. Additionally, net income margin improved significantly from -0.5% to 2.1%. These increases in profit margins were likely driven by the company's strategic decisions and operational improvements. Adjusted EBITDA and net income also showed substantial growth, with adjusted EBITDA increasing from $13,270 to $112,201, and adjusted net income rising from $13,270 to $26,409. Overall, these changes indicate a significant improvement in the company's financial performance between 2024 and 2025. The company's financial performance indicates a significant improvement in its ability to generate cash from its core operations. The data shows that the net cash provided by operating activities has increased substantially over the past year. In 2025, the company generated $82,567 million in positive operating cash flow, compared to $40,663 million in 2024. This represents a notable increase of $41,904 million, or approximately 103% from the previous year. This trend suggests that the company's operations are becoming more efficient and profitable, enabling it to generate substantial amounts of cash from its core business activities. The positive operating cash flow is a key indicator of a company's financial health and stability, as it indicates its ability to meet its short-term obligations and invest in future growth opportunities. The company's debt level has undergone significant changes over the past year. Initially, total liabilities and long-term debt increased from $2,326,893 to $2,389,440 and $1,573,614 to $1,704,656 respectively. However, this increase was largely due to two major acquisitions: the purchase of certain assets from affiliates of Vulcan Materials Company for $108.4 million and P&S Paving, LLC for $88.2 million. On the other hand, cash and restricted cash have increased, indicating a decrease in debt level. In terms of interest expenses, there has been a mixed trend. Initially, interest expense decreased by 51.1% from $27,370 to $18,130. However, this trend was reversed as interest expense increased significantly from $15,051 to $26,365 due to the acquisition of new assets and liabilities. Furthermore, interest expense, net, increased by 51% to $27.4 million in 2025 compared to $18.1 million in 2024. Overall, while there has been a decrease in debt level, interest expenses have increased significantly due to the company's acquisition activities. Management is optimistic about the company's outlook and strategy for growth. The business is subject to seasonality, but warmer weather in the third and fourth quarters typically leads to increased activity and revenue. To capitalize on this trend, management plans to continue expanding operations through strategic acquisitions, investing in property, plant, and equipment to support its operations. The company has already made significant strides in this area, with recent acquisitions in southeastern Texas and Florida. Management expects total capital expenditures to be between $165 million and $185 million in fiscal 2026, which will be used to fund these growth initiatives. With a strong cash position and significant proceeds from financing activities, the company is well equipped to execute its strategy and achieve continued growth. Overall, management's outlook is positive, with a focus on leveraging seasonal trends and strategic acquisitions to drive revenue and expansion. The company has made several strategic acquisitions to expand its operations and assets. In October 2025, the company acquired certain asphalt manufacturing and construction assets from affiliates of Vulcan Materials Company in Houston, Texas. This was followed by the acquisition of all equity interests of P&S Paving, LLC, an asphalt manufacturing and construction business in Daytona Beach, Florida on the same month. In January 2026, the company acquired GMJ Paving Company, LLC. Additionally, a conditional purchase agreement for real property in Central Texas, known as the Lone Star Acquisition, was entered into but expired by December 31, 2025. Despite these acquisitions, there were no divestitures explicitly mentioned in the provided information. The company's financial activities have been focused on share buybacks in recent periods. According to the provided information, a significant number of shares were repurchased through open market transactions. Specifically, 15,382 shares were bought back for $1.6 million. This indicates that instead of distributing profits as dividends, the company has chosen to use its funds to purchase its own shares. Concerns about inventory buildup are emerging due to significant increases in stock levels over a short period of time. According to the data on page 1, inventories rose from $155,133 to $170,019 between September 30 and December 31, 2025, indicating a substantial accumulation of goods. Furthermore, another instance of inventory buildup is observed on page 38, where stock levels increased from $10.4 million to $13.3 million between December 31, 2024 and December 31, 2025. These increases suggest that companies may be facing challenges in managing their supply chains effectively, potentially leading to issues such as storage costs, obsolescence, and reduced cash flow. The rapid accumulation of inventory raises concerns about the potential for supply chain disruption if demand does not materialize or if production slows down. This could lead to costly write-offs, reduced profitability, and decreased competitiveness in the market. As a result, companies need to reassess their inventory management strategies to mitigate these risks and ensure that they are aligned with changing market conditions. That concludes the financial summary for Construction Partners, Inc. Feel free to comment below, and I will be happy to answer them when possible.